Sliding US consumer confidence hammers US Treasury bond yields down to their lowest levels since December. Australia's January CPI today could give clues on the RBA's rate cut path. Australian consumer confidence jumps after the RBA's cut this month, and the Bank of Korea cuts rates after recent political turmoil. That's coming up in our 5 Things in 5 Minutes on Wednesday, February the 26th. And then in today's bonus deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes looks at the prospects of OPEC actually reversing its long-planned and often delayed COVID production cuts from the 1st of April.
We're now seeing this languishing sort of oil price really raising the prospect of OPEC delaying it for the 4th time, considering that the price of oil is significantly below where we see or where we feel a lot of the OPEC producers want it to be.
But first, in 5 and 5 with ANZ, global markets are focused on the risks of slower US economic growth this morning after a big fall in US consumer confidence. The S&P 500 is down 0.8% at 4 a.m. Sydney Melbourne time, while the US 10-year Treasury bond yield was down 15 basis points from yesterday morning at 4.30%. That's its lowest point since December last year. Here's ANZ Head of G3 Economics, Brian Martin, who says a surprisingly big fall in consumer confidence measured by the Conference Board is worrying investors.
The breakdown of the surveys are showing that uncertainty about tariffs is having an impact, certainly in helping to push inflation expectations higher. The average one-year inflation expectation in the Conference Board Consumer Confidence Survey rose to 6% from 5.2%. But it's not just tariffs that are unsettling consumers. The broader economic policies of the new administration, as they unfold, are leading to some uncertainty. For example, the federal workforce.
As of 4 a.m. Sydney Melbourne time, the US dollar was down 0.2%, the Aussie dollar was down 0.3% at 63.33 US cents, while the Kiwi was down 0.4% at 57.14 US cents. Oil prices also fell 2.4% to their lowest levels since December. Number 2, Australia's January CPI figures today could show headline inflation falling to 2.1% year on year, according to ANZ Research. Now, that's below the Reserve Bank of Australia's 2 to 3% target band. But as ANZ senior economist Adelaide Timbrell explains, the partial January data might underestimate where CPI inflation actually is.
Australia's monthly CPI indicator is not as comprehensive as the quarterly print. There are 3 subsets of goods and services that households purchase that are measured in each month of each quarter. The first month of each quarter has more goods and fewer services than the other months. This means that when goods are adding less inflation than services, the first month of the quarter can underestimate the overall inflation pulse.
Number 3, ANZ Roy Morgan's measure of Australian consumer confidence rose nearly 5 points last week to 89.8, its highest since May 2022. ANZ economist Sophia Angala says the jump followed the RBA's 25 basis point cut to interest rates and commentary that inflation was moderating.
Confidence amongst mortgage holders jumped nearly 11 points to its highest level since early May 2022, and that was before the beginning of the RBA's hiking cycle. Mortgage holder confidence is now slightly higher than the confidence of outright homeowners, who often benefit from higher interest rates, and the confidence of outright homeowners remained largely steady last week. Meanwhile, renter confidence also rose last week, but confidence remains the lowest of the 3 housing cohorts.
Number 4, the Bank of Korea cut its benchmark rate unanimously by 25 basis points to 2.75% yesterday in a bid to support growth amid political uncertainty. ANZ economist Crystal Tan says further easing was signalled, although the rate-setting committee was split on how much.
The governor did mention that the market expectation for the Bank of Korea to deliver 2 to 3 rate cuts in 2025, including the February reduction, is in line with its own assumption. Now, having said that, the pace of easing is slightly too slow. There was a split in the forward guidance. 4 members prefer a rate hold in the next 3 months. The Bank of Korea also signaled the desire to monitor the impact of earlier rate cuts in deciding the timing and pace of future easing. So overall, we're still sticking with our base case of at least one more 25 basis point rate cut this year. That would likely be delivered in May.
Number 5. Japan's Services Producer Price Index rose 3.1% in January from a year ago, keeping up a run of around 3% annual growth since mid-2024. The strength followed a 4.2% jump in the goods PPI earlier this month. ANZ FX analyst Felix Ryan says the data adds to inflationary pressure, including in wages and CPI data as well.
Our view currently is still for a fairly cautious Bank of Japan policy normalization, so we still see 2 more rate hikes, bringing the terminal rate or terminal interest rate in Japan up to 1% by the end of the year. So those rate hikes will happen in Q3 and Q4. At this stage, we still see many of the Bank of Japan board members still exercising some caution around interest rate policy normalization from here, just to preserve that rebound in growth that we're seeing in the Japanese economy.
Felix Ryan there. Now, in our bonus deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes looks at how much OPEC producers need the oil price to lift to meet their break-even targets this year, as a key decision looms on whether to reverse production cuts made all the way back during COVID.
We're coming up to a pretty important juncture. I mean, clearly there's a lot of geopolitical noise at the moment, which we won't go into too much detail, but certainly the spectre, I suppose, of rising supply coming from OPEC is hanging over the market. Now, if we take a step back last year, essentially around COVID, they voluntarily cut output to support prices, and last year they did agree to start to phase those voluntary cuts out. Now, they've already been delayed 3 times, that production hike, and the current start date for that was the 1st of April. But we're now seeing this languishing sort of oil price really raising the prospect of OPEC delaying it for the 4th time, considering that the price of oil is significantly below where we see or where we feel the a lot of the OPEC producers want it to be. And that's based around the fiscal break-even price. So essentially the price of oil they need to balance their own budget, because they are predominantly oil-producing, oil-dominated sort of countries. You know, they get most of their revenue from the oil industry. So it's a pretty easy calculation to see how much revenue they need to get in to maintain the current spending that they're doing across the country. And those headwinds are just getting stronger and stronger, and not to do with costs. Certainly the physical cost of producing oil is very low, but countries like Saudi Arabia are looking to diversify their economy away from oil and are spending up big on other sectors. And so their budgetary requirement just growing and growing, which is putting more pressure on them to manage the oil market to obtain the highest amount of revenue they can get through the door.
Yeah, I was surprised to see the fiscal break-even price for Saudi Arabia is up now to $98 a barrel, which is quite a thing when the price of oil is around $70, $75 a barrel.
Yeah, and it gives you a sense, I suppose, of where the pressures lie. The Saudi Arabians are the ones which have managed the most volume or kept the most volume off the oil market. And so, you know, they're pretty keen to, I suppose, decrease that spread between where current prices are and where they really need them to be to meet some of those spending programs that they have in place for the next fiscal year. And so I think that's going to be the driving force behind any decision to delay the production hikes over the next couple of months.
Just one thing to watch out for. I see there's the chance that several 100,000 barrels a day of Iraqi oil could start flowing through Kurdistan to Turkey. How much of a factor might that be if and when it's confirmed?
Oh, most definitely it's a pretty big factor. I think, you know, the market had sort of assumed that was pretty much off, you know, for the foreseeable future. And so the sudden resumption of those exports can certainly make a difference in what we see as a fairly balanced market at the moment. But it's a part of a broader sort of issue around overcapacity in a lot of OPEC countries as well. Under the current supply quotas, several producers exceeding those quotas, which is, I suppose, just diluting the impact of the production cuts overall. So it's part of a broader issue for OPEC to look into as they come up to this next phase of their supply agreement.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, February the 26th. Catch you tomorrow with analysis of what Australia's January inflation data could mean for the RBA and Australian interest rates. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.